Well, hello. Welcome to week 9. What we are going to do today, or this week, I'm sorry, is two things. Finish up a little bit of the exchange rate stuff that is held over from week 8. And then I'm super excited because we get to start to reap the benefits of all the hard work that we've done in the course so far, particularly in the macro section, where we put this stuff together and talk about. A model for the macroeconomy. But that'll be in the next set of notes. For now, what I want to do is talk about the last element of this broad topic of exchange rates, and that's the notion of fixed exchange rates. And the reason that I want to do this is because some of you may be may have chosen countries for your project that where the country has a fixed exchange rate system or a managed exchange rate system, and then also it's just an interesting application of demand and supply. So, what do we mean when we say there are fixed exchange rates? Well, this is in contrast to what we were talking about in the previous set of notes, where we described the sorts of things that would shift the demand, say in the foreign exchange market, the demand for dollars or the supply of dollars, and result in either a nominal appreciation of the dollar or nominal depreciation of the dollar. So, for instance, we talked about the idea that if interest rates in the US were to rise relative to those in the rest of the world, then this would be something that would cause the demand for dollars in the foreign exchange market to rise and the supply of dollars in the foreign exchange market to fall. And if the market clears, in other words, if the exchange rate moves in a way to equilibrate the quantity demanded and quantity supplied of dollars, we would predict that the dollar would appreciate relative to the foreign currency. So, a fixed exchange rate system is one in which the exchange rate can't do that job. It can't solve an imbalance between quantity demanded and quantity supplied. And as a result, it has to be actions, typically of a country's central bank. So that's why in this I say the central bank has promised. We could just say more generically, a country has promised to convert its currency to another currency's at a fixed rate. And for a fixed exchange rate system to work well, that fixed exchange rate needs to be established and maintained for a reasonably long period of time so that there's a certain degree of predictability and credibility that goes with that exchange rate system. And we'll talk about this to some degree on the next slide. I again say the central bank has promised as more specificity here because, again, generally it's the concerted efforts of the central bank first and foremost in a country, but then perhaps in concert with a treasury department, for instance, that will undertake actions to maintain that fixed exchange rate in the manner that we'll describe subsequently. So there are many different types of fixed exchange rate systems, and you could think about them on a spectrum from um, uh, most extreme to least extreme. And if you wanted to think about, a really broad spectrum, over here you'd have completely fixed exchange rates, and over here you might have a pure floating exchange rate. In the hardest version of a fixed exchange rate, you have, say, this notion of dollarization or adopting another currency. So this is the most extreme form of a fixed exchange rate system in that that the country that is a participant in this fixed exchange rate system has no ability to change the relative availability of the currency. So dollarization is a phrase that refers to the idea that a foreign country uses another country's currency as its own currency. The majority of instances in which this happens, the currency that is used in the respective country is the US dollar, and that's why it's taken on this shorthand of dollarization. But there are other instances where countries have have fixed exchange rates and adopted the currency of another country other than the U.S. dollar. And so you can see examples of this. I posted a very long, kind of nerdy IMF report in Canvas, and if you were really curious or couldn't sleep, perhaps you could look at that and see the different types of ways in which countries manage their exchange rate system. So what would be an example of dollarization? Ecuador. Ecuador uses the US dollar, for instance, as its currency, as do many other countries. A currency union is an arrangement among several sovereign countries to adopt a common currency. And so the more relaxed version of this would be a currency union in which you have several sovereign countries that agree to maintain multilateral fixed exchange rates. So, in the period leading up to the adoption of the euro, the countries that were the initial adopters first had a long period in which their multilateral exchange rates were held fixed, and then after that came the removal from circulation of the respective countries' currencies, like the Deutschmark and the Lira, the Deutschmark in Germany, the Lira in Italy, and so forth, and the adoption of the euro. Somewhat more stepped off of that extreme case would be all uh, so so maybe we call this extreme fixed or perfectly fixed. Maybe in here we can put this idea that we just have uh, more generic fixed exchange rates. So examples of this would be that, or the idea here would be that you maintain your own currency in circulation, but legally mandate its convertibility to another country's currency, or perhaps to a basket of currencies, or perhaps to a commodity like gold. So, in the post World War II period until 1971, the US and many of the countries in Europe were participants in the Bretton Woods gold standard. And so that was an example in which the countries in Europe fixed the value of their currency to the US dollar, and then the US dollar in turn was convertible to gold. So de facto, those countries' currencies were convertible to gold, but it was the gold dollar exchange rate that drove things. The Hong Kong dollar, for instance, is pegged to the US dollar. The Venezuelan bolivar is pegged to the US dollar. And pegged is just a shorthand way of saying fixed. China used to maintain its currency with respect to the dollar and then a basket of currencies, and it's relaxed a little bit over the recent years. I don't know, last 8 years or so, where it's more managed. It's kind of a hybrid between peg and what we're about to talk about now. So a managed float is in here. So a pure float means that we let demand and supply strictly drive countries' currency values, and there is absolutely never an intervention in the foreign exchange market. So, as you might surmise, there is no country for which they have a pure floating exchange rate system. On the other hand, there are many countries that come close to this, and the United States would be one example of this. The US intervenes in the foreign exchange market only rarely, and generally it's a concerted effort on the part of the US and many other countries to try to realign currency values. And it's a big deal. When the US actively tries to change the value of the country's currency, it's in the press. And I have one example of it, a dated example, but still kind of the last huge time that the US intervened in the foreign exchange market. at the very end of these notes. There have been some other somewhat smaller efforts in the period from the 1980s to the present, but and a lot of jawboning. So jawboning just means that somebody at a central bank or in the central government will talk up or talk down the value of the currency, saying we think the currency should be higher or lower, for instance. But that's not the same thing as intervening in the foreign exchange market in the manner that we're going to describe. So a managed float is sort of the happy way of describing this, and a dirty float is the pejoratively bad way of describing this. So a managed float means that a country wishes to maintain its currency value in a way that it can control, and it clearly states that it will intervene in the foreign exchange market when it feels that exchange rates are kind of out of whack. So there's no ambiguity about the fact that the country is intervening in the foreign exchange market. And we'll talk about what that means in the context of these notes. When one country alleges that another country engages in a dirty float, so the most sort of loud and belligerent examples of this would be the U.S. Historically looking at China and making allegations of dirty floats, or Japan and some other, but particularly Japan and China over the years, and by years I mean last 30 years or so. What the allegation of a dirty float is the suggestion that a country has publicly said we're going to let our currency float, and we're not going to intervene in the foreign exchange market, but then more surreptitiously does in fact intervene in the foreign exchange market. So that's the sense in which somebody refers to this as dirty. One question before we kind of talk about the mechanics that you might have is, why would a country choose to fix an exchange rate? And as should come as no surprise in an economics class, there are pros and cons to this choice. And so what I want to do is think about what might be the advantages to a particular country of having a fixed exchange rate system, but then as well its disadvantages. So a fixed exchange rate system is going to be particularly useful for countries that engage in international trade. So again, a lot of international trade. So again, we've noted that the US, for instance, is a relatively closed economy, and it's also pretty dang big. And so it doesn't engage in fixed exchange rate systems with any other countries in the current environment. But one of the motivators for the adoption of the euro, and before that the system of multilateral fixed exchange rates in Western Europe, was because those countries were being buffeted by severe fluctuations in exchange rates, both within the Western Euro area, as well as vis-a-vis the United States. And so those countries that were particularly reliant, because those countries were particularly reliant on trade, they wanted to try to protect themselves. And so fixed exchange rates can enhance international trade and promote some degree of stability, because if we think about floating exchange rates, every time the currency appreciates or depreciates, if that translates into real appreciations and depreciations, can reduce or increase, respectively, net exports. And so the more volatile is the nominal exchange rate, the more volatile are net exports, and the more volatile then is the economic performance of a particular country. So, and as well, the more volatile is the nominal exchange rate, then the more volatile are, say, the domestic economy's price of foreign goods and services, and vice versa. So having a fixed exchange rate can enhance international trade in the sense that it promotes some degree of stability in relative prices and eliminates exchange rate risk. So this then can also incentivize foreign investment in an economy, both portfolio investment as well as foreign direct investment. If a person in the rest of the world or an entity in the rest of the world has a reasonable expectation that the currency will be stable so that their returns are predictable, this is something that can enhance investment. Fixed exchange rates might provide a signal to the rest of the world that the country is very serious about maintaining this exchange rate, as well as promoting not only economic stability, but perhaps also political stability in the country. And so, on that margin, it might discourage speculative behavior. But as we'll see on the con side, that's not a blanket statement. And fixed exchange rates can, as we'll see a little bit today, and then as we kind of consider this, I'll try and be deliberate about it later on in the semester. They can provide discipline on the way in which a country conducts its monetary policy and fiscal policy. And the way to think about this is that if you go back to, how we thought about the fluctuations in exchange rates, we said the nominal exchange rate is going to bounce around, appreciate or depreciate, as, for instance, relative real interest rates and relative prices in the economy change. Well, turning that on its head, if the exchange rate is not bouncing around, then it must be that there is a pretty tight correspondence between interest rates in the country that is choosing the fixed exchange rate and interest rates in the other foreign country. And so this means, and same thing for prices. And so, to the extent that we have already seen that, say, fiscal policy affects interest rates, so we saw that with our characterization of the loanable funds market, and we will talk about the role of monetary policy with respect to inflation and interest rates as we proceed through the next several chapters in the textbook. This is saying that there's some discipline on the way in which countries are conducting their policies. And this also is a good time to point out that exchange rate systems can be bilateral fixes or they can be unilateral fixes. So, in our previous slide where I said the Hong Kong dollar is fixed to the US dollar, that's a unilateral decision. The Hong Kong Monetary Authority is undertaking actions to ensure that the Hong Kong dollar remains stable, fixed, with respect to the US dollar. In the United States, there is no consideration in the conduct of monetary policy or the foreign exchange market about what is happening in the Hong Kong market. It is strictly the responsibility of the Hong Kong Monetary Authority to maintain that peg. Now, in say the lead up to the adoption of the euro, there it was a situation in which France and Germany and Italy and Portugal and Spain and so forth all agreed to be mutually responsible for maintaining fixed exchange rates. So, in that case, all of the countries were behaving with an eye towards exchange rate management. So, a fixed exchange rate, just as an aside, can be unilateral or bilateral, multilateral. So it's not all rainbows and bunnies and sunshine when we think about fixed exchange rates. There are some notable advantages, but there are some disadvantages. So the overwhelmingly important one, I think, well, one of the overwhelmingly important disadvantages is the requirement that we have a lot of information. So an example of this is very dated, but after World War One, the United Kingdom had gone off the gold standard. Many other countries remained on the gold standard, and the United Kingdom needed to determine, first of all, whether to return to the gold standard, and then secondarily, at what price. And it is very, very interesting history that I would encourage you to look into if you are so inclined, or if you want some reading, I can direct you to some reading. But what happened was that the UK adopted a fixed exchange rate that led to the overvaluation of the pound relative to gold and other countries' currencies. And as a result, speculative behavior drove the value of the pound down and ultimately forced the UK to adjust its behavior vis-a-vis fixed exchange rates. So it's an interesting period in economic history. And so, going along with that, maintaining the fixed exchange rate can potentially conflict with other objectives for the domestic macroeconomy. So, case in point, Venezuela, one of the countries that, one of the examples that we'll consider in these notes, has a fixed exchange rate vis-a-vis the US dollar, at least in name. And so if it is the case that a country is, say, in a recession, and it has a fixed exchange rate system, like for instance, Venezuela, we have noted that lower domestic incomes, among other impacts of a recession, would serve to depreciate that currency. If the currency is to remain fixed in value, however, the country would have to undertake actions to prevent that depreciation. So, one thing that Venezuela could do, or any other country faced with this situation, would be to undertake actions that would offset that depressing behavior. And the obvious one on the part of, say, monetary policy is to raise interest rates. But we have already seen, and we'll see this again in the notes to come, that higher interest rates will serve to contract economic behavior. So if what was already driving problems with maintaining the fixed exchange rate was an economy that was contracting, then maintaining the fixed exchange rate requires that that domestic economy also contract further. So this is potentially problematic, and what fixed exchange rates mean is that often, well, not often, always, a country will have to sacrifice its domestic priorities in favor of this international priority of maintaining fixed exchange rates. And we'll see this in the examples that we take up in these notes. Um, to the extent that a country needs to intervene in the foreign exchange rate to maintain the fixed exchange rate, then it also necessitates having large holdings of at least one foreign currency or a commodity like gold in case intervention is needed. And there are opportunity costs to that, and sometimes getting those currency holdings can be a difficult endeavor. And so then, almost paradoxically, we have item number 3 on the advantages, but item number 4 on the disadvantages. And that is that while fixed exchange rates might signal that the economy is committed to political and economic stability, it can also be the case that if people believe that that commitment is flagging, then that can encourage speculative behavior. So, speculative behavior can occur when the understanding is that to defend your currency, you need a lot of another country's currency. If that cover becomes too low, then people will engage in a speculative attack on your currency and drive the exchange rate lower, and ultimately force the undoing of the fixed exchange rate. And then similarly, speculative behavior can occur even if the foreign exchange cover is okay, but just the market participants, speculators in the foreign exchange market, think that there might be a problem with a country's commitment to the fixed exchange rate system. So for it's outside of the realm of the time frame for your group project, but for those of you who are looking at countries in Asia, in the late 1990s, beginning 1997 and continuing more or less through 1999, there was a series of financial crises that originated in large measure in foreign exchange markets in the countries in East Asia. And in some instances, there was no problem with the country having a sufficient holding of foreign exchange reserves, typically US dollars. And if speculators hadn't intervened in the market, but it was only when that speculative behavior occurred and there was a dumping of the currencies of East Asia, like the won in South Korea is one, and the baht in Thailand, that those fixed exchange rates became undone. So again, a very interesting period in economic history. And if you're interested in learning more, I can point you in the direction of some reading. So what I'd like to do is consider two examples to illustrate what happened, how we think about the maintenance of fixed exchange rates. So let's consider the Bretton Woods system. So again, the Bretton Woods system was in place from the end of World War II until 1971. And the Bretton Woods system came undone when not only Germany, but it was particularly the German experience vis-a-vis the United States that contributed to the collapse of this fixed exchange rate system, or this gold system. So what I have with the dashed lines here, the initial supply and initial demand, is the idea that we could imagine a fixed exchange rate, say, at 3.7 Deutschmark per dollar. So the Deutschmark was the currency in Germany prior to the adoption of the euro. So we're taking this from the perspective of the US right now, kind of consistent with the other treatment in the book. And we've got the price of dollars, therefore, on the vertical axis. Now, if the gray dashed demand and supply curves were the relevant ones, then everything is just fine, because what we have is a situation in which the equilibrium that's implied by the equilibrium exchange rate that's implied by the demand and supply curves is the fixed exchange rate. But what was happening during this time period, and it took off in a big way in the 1960s, particularly so it took off in a big way in the 1960s in the US, was very, very expansionary fiscal policy, and as we'll see a little bit later, perhaps monetary policy with that. So what was happening? We had in the early 1960s very significant tax cuts on the part of the Kennedy administration to try to stimulate investment and economic performance in the US. Excuse me, continuing through the 1960s, when Johnson became the president, there was an expansion of social programs. So the push with Great Society programs, things that we consider now to be entitlements, were put into place at that point. And then, of course, looming throughout this period is particularly in the latter 1960s, is the Vietnam War. And so there was tremendous spending by the government on military. And so these things revved up the US economy. And so we saw that income levels in the US rose relative to those abroad. And it's also the case that the US had significantly higher prices or faster rates of inflation than abroad. So we've already seen that higher income in the US is something that would increase the supply of dollars, and higher prices in the US, say relative to prices in Germany, would serve to as well increase the supply of dollars and decrease the demand for dollars. And there were other things going on, but these are significant enough to give us the picture that we have. So we could imagine the consequence of this time period is that originally the demand and supply curves were the gray dashed ones that would imply an equilibrium exchange rate that was the fixed exchange rate. But then these factors are happening in the US that cause the supply of dollars to shift out to the right and the demand for dollars to shift out to the left. And as a result, we have an equilibrium exchange rate that an equilibrium exchange rate in the foreign exchange market that is below the fixed exchange rate. Now, the fixed exchange rate is the one that is legally mandated. So even though the demand and the supply curve would imply a lower value for the dollar, lower price of the dollar, say 2.86 Deutschmark per dollar, it is the case that Germany and the US, but Germany has agreed to change Deutschmark for dollars at this price of 3.7 Deutschmark per dollar. So we have a situation in which the dollar, of course, is overvalued relative to the German Deutschmark. And again, to repeat what we saw in previous notes, what do we mean by that? What does overvalued mean? Overvalued means we have an excess supply of dollars at that fixed exchange rate. And conversely, if we have too many dollars in circulation, it's relative to what? Well, relative to Deutschmark. So there's a relative shortage of Deutschmark. And what we could kind of, if we scratch our heads and think about it a little bit, is recognize that if we need to maintain this fixed exchange rate, we need to resolve this imbalance. And by we, I mean in the royal sense, say Germany, if it has as its objective maintaining that fixed exchange rate, needs to undertake actions that would prevent the dollar from depreciating. So, right, the demand and supply curve are implying that the value of the dollar should be lower in order to maintain that exchange rate. The monetary authorities need to figure out some way to prevent the dollar from depreciating. So this is where we kind of go back to chapter 4 with demand and supply type stuff and say, well, okay, if we have an excess supply of something that would tend to put downward pressure on the price, then to prevent that from happening, we need to get rid of that excess supply. We need to, in this case, get dollars out of circulation in the foreign exchange market. And similarly, if there's a relative shortage of Deutschmark that is driving the value of the Deutschmark higher, so the dollar is overvalued, the Deutschmark is undervalued, then we need to make Deutschmark relatively more abundant. So it would be just like the workings of any other market. So in terms of what's happening, again, if this fixed exchange rate is 3.7 Deutschmark per dollar, but the demand and supply curves are implying that the exchange rate should be lower, then to address that undervaluation of the Deutschmark and overvaluation of the dollar, the German central bank needed to, as I said, sop up or get rid of that excess supply of dollars. So how did they do that? Well, they went into the foreign exchange market, the Bundesbank, the German central bank at the time, and bought them. It bought dollars because it, of course, can create Deutschmark. It created at that time its own currency. So if you think about this from a sort of fanciful perspective, you can think about the German central bank going into the foreign exchange market and contacting people who have dollars and say, I'm going to give you Deutschmark at this rate of 3.7 Deutschmark per dollar. And so the Deutschmark are going out, and the central bank, the Bundesbank, takes these dollars and tucks them away in a vault. So they are effectively out of circulation. So effectively, what's happening is the German central bank is making Deutschmark much, much more abundant in circulation and is making dollars relatively scarce in circulation. Now, from a political point of view, for those of you who are students of political history, the U.S. could have helped by intervening in the foreign exchange market and vis-a-vis this a similar sort of transaction, but on the U.S. side, as well as manipulating the price of gold, but declined to do so because to do so in the U.S. would have, as I suggested was a problem earlier, amounted to the U.S. undertaking actions that would have slowed that domestic expansion. And so this is so the U.S. was just like, yeah, no, it's not our political obligation to maintain this exchange rate. And indeed, the way the Bretton Woods system was set up, it was the principal obligation of the countries of Europe to maintain the value of their currency vis-a-vis the dollar, and then the U.S.'s obligation to maintain the value of the dollar vis-a-vis gold. So, how does this intervention work? So, again, what's happening? Bundesbank is going into the foreign exchange market. It's buying dollars and retiring them. You know, do you think about it, shoving it in a deep, dark vault way down in its bank? They're completely out of circulation and making Deutschmark much, much more abundant. And so, removing something from a market means it's becoming more scarce. So dollars are becoming more scarce, which should serve to drive up its value, which is what we want. And Deutschmark are becoming relatively more abundant, and so that should serve to reduce the value of the Deutschmark until we get to this exchange rate again, or we're able to maintain this exchange rate of 3.7 Deutschmark per dollar. So, this foreign exchange market intervention works in the immediate short run because it resolves the imbalance between quantity supplied and quantity demanded. So, again, I want to uh, remind you of that in this picture. At this fixed exchange rate, this is the quantity supplied of dollars here, and this is the quantity demanded of dollars. And we have this excess supply of dollars in the foreign exchange market that Germany is basically solving by buying dollars and selling Deutschmark to market participants and removing those dollars from circulation. So this works as well in the longer run, as long as Germany was willing to continue to do this. Now, what is the consequence in Germany? Effectively, what Germany is doing is printing Deutschmark, printing Deutschmark, printing Deutschmark, so issuing more and more and more Deutschmark. Now, in the foreign exchange market, that does what we want it to do, but in the domestic economy, having more and more and more of a country's currency tends to drive up prices. We'll see this in especially chapters 20 and 22. But effectively, what's happening is in Germany, the money supply was rising. It was rising faster than the pace of the real production of goods and services. And so prices in the German economy were rising. Now, Germany was okay tolerating that inflation in its economy for a little while. But again, this is where history is so important. Of course, in the period leading up to World War II, and as a result of war reparations that Germany had to pay at the conclusion of World War I, Germany experienced profound inflation, hyperinflation in their economy, and they had been vigilant in the post-World War II period to undertake actions that would prevent a resurgence of that. And even to this day, it's why in the German economy they are so keen on minimizing inflation, not only in their economy, but more practically in the Eurozone. So Germany eventually got to the point in the late 1960s and early part of the 1970s where it just said, no, we don't want to do this. The United States needs to do a little bit more to help with this system and solve this relative imbalance in the foreign exchange market. And then ultimately, that is what led to the collapse of the Bretton Woods system. So a country can defend its own currency if it's undervalued, as long as it's willing to continue to go into the foreign exchange market, buy the other country's currency, and effectively make its currency more abundant, and have higher inflation as a result in the domestic economy. And when that process ceases to be palatable from either an economic or a political point of view, then the exchange rate becomes undone. It breaks. Here would be another example going in the other direction. So we can take the Venezuelan economy. So the bolivar is the, oops, I have a typo here. This should be an F. The bolivar is the currency in Venezuela, and Venezuela, if you go look, and maybe I can't remember whether anybody is doing this for their country study or not, is experiencing profound hyperinflation and severe problems in the domestic economy, tragic problems in the domestic economy. So much so that when I was preparing these notes, the reason I have that typo there is that in the last several years, there have been adoptions of three types of currency in Venezuela. So there was originally the Venezuelan bolivar, and then the Venezuelan fuerte, which is what I'm depicting here, and then more recently another currency that what's happening with the adoption of these currencies is that they are essentially having to just lop a bunch of zeros off of the denominations of the currencies because of the degree of hyperinflation. So for us, we won't worry about that. But if you're interested in it, you can easily go read even Wikipedia on the Venezuelan economy. So let's suppose that the Venezuelan economy has a fixed exchange rate vis-a-vis the dollar of 10 bolivar per dollar. And let's suppose that the demand and supply curves are such that it implies that the appropriate exchange rate is 15 bolivar per dollar. So how could we have gotten there? Well, it could have been the case again, just as we saw before, that initially there was a demand and supply curves that were indicated, say, by these gray dashes. Um, and then both because of political reasons, there is heightened riskiness in being in the Venezuelan economy, speculative behavior, presuming that there is a host of problems from a political and social or political and economic point of view in this economy that lead to fewer dollars being supplied in the foreign exchange market for purposes of acquiring the Venezuelan bolivar, and people in Venezuela, for instance, seeking protection for the value of their currency might seek dollars, so an increase in the demand for dollars. Similarly, as I said, there's been profound hyperinflation in this economy, and of course the higher prices in Venezuela would serve to discourage the supply of dollars to the foreign exchange market because you wouldn't dollar holders would be disinclined to buying these higher priced Venezuelan goods and services. And similarly, people in Venezuela would increase the demand for dollars in the foreign exchange market in an effort to acquire relatively lower priced goods and services, say coming from the United States or from perhaps from other countries as well. So again, our starting point is that initially the demand and supply curves implied an equilibrium at this fixed exchange rate, but then circumstances change and the demand and supply curves shift with the result that the dollar is undervalued relative to the bolivar. And we can observe, again, similar but opposite from our previous example, assessment. So at the fixed exchange rate now, we have an excess demand for dollars. So quantity demanded of dollars, right, is bigger than the quantity supplied of dollars at the fixed exchange rate. And this is, in other words, a shortage. So there is a shortage of dollars in the foreign exchange market. Similarly, if there is a shortage of dollars, it has to be relative to what? Relative to bolivars. So there is an excess supply of bolivar in the foreign exchange market. And this is the same thing as saying that the dollar is undervalued relative to the bolivar. And to maintain this fixed exchange rate requires that we prevent the dollar from appreciating relative to the bolivar, and similarly prevent the bolivar from depreciating relative to the dollar. So, what do we have to do? In order to prevent the price of something from going up, so here we are trying to prevent, or Venezuela is trying to prevent the price of the dollar from going up. Venezuela needs to undertake actions to make dollars relatively more abundant in the foreign exchange market. So there's a shortage of dollars. Venezuela needs to satisfy that shortage of dollars. So, what does it do to maintain that fixed exchange rate? It's going to intervene in the foreign exchange market and sell dollars, which it has to hold in order to maintain convertibility. And in exchange, reduce the relative excess supply of Bolivar. So pull in Bolivar to its coffers and just put them away, retire them from circulation. So the only way that Venezuela can maintain this fixed exchange rate is to address this relative shortage of dollars, and it addresses that shortage of dollars by selling dollars in the foreign exchange market and buying its currency. So again, sorry, I'll correct this and repost the notes, but and buying the Bolivar. So whatever, Bolivar. So it has dollars because that's how it backs the fixed exchange rate. So this works in the immediate short run because to maintain the fixed exchange rate requires resolving that imbalance between quantity supplied and quantity demanded. So specifically, there's a shortage of dollars. And the Venezuelan central bank satisfies that by selling dollars in the foreign exchange market. It works in the longer run as long as Venezuela has dollars with which to purchase its own currency. We will see in these subsequent chapters that this also amounts to a contraction in the Venezuelan money supply, and so is contractionary in the domestic economy. That is, in present day terms, not something beneficial for Venezuela, and is something that is therefore providing attention for the country in terms of whether it focuses its attention on maintaining that fixed exchange rate or whether it instead addresses the domestic recession that's happening in its economy. So, our conclusion then from this is that if a country wants to defend its own overvalued currency, so in other words, Venezuela's currency is overvalued in the foreign exchange market, the dollar is undervalued, it can do so as long as it has holdings of foreign exchange reserves. And when it ceases to have sufficient holdings, then the game is up and that foreign exchange market intervention can't happen anymore and the fixed exchange rate collapses. And so this is something that, again, some of you may see in your country studies. And so, what I want to do in this last couple of slides is to suggest to you that a managed exchange rate system has analogies to thinking about fixed exchange rates. So, if a country is trying to manage its exchange rate, what it's trying to do is hit a particular target. So, let's suppose that we think about Japan. And the demand and supply of dollars are such that the equilibrium exchange rate is 105 yen per dollar, or equivalently over here in the foreign exchange market from the perspective of Japan, this number is 1/105. Right. So dollars per yen, 0.0095 dollars per yen. So what if Japan wants to keep the value of the yen low relative to the dollar? So this is the same thing as saying the value of the dollar high relative to the yen, of course. So that's what we're showing over here, and the yen low relative to the US dollar is what we're showing here. So the value of the dollar higher than the equilibrium implied exchange rate, and similarly, the price of the yen below the one that would be implied by the workings of supply and demand. So, why would Japan want to do that? Well, again, other things equal, the higher is the value of the dollar and the lower is the value of the yen. The cheaper are Japanese goods and services to citizens in the US, and so that would be something that could stimulate net exports from Japan and therefore stimulate economic behavior or economic outcomes. GDP would rise in Japan if it is the case that the yen is falling or low. So, how does Japan drive the dollar higher and the yen lower? So, again, suppose it's the case that Japan wants the value of the dollar rather than 105 yen per dollar to be 108, or equivalently, we have this exchange rate from the perspective of Japan. Well, what we would say is if it is the case that Japan is targeting this exchange rate of 108 yen per dollar, then it needs to recognize that at that exchange rate, there would be an excess supply of dollars. And similarly, at that exchange rate, from the perspective of the yen, there would be an excess demand for yen. So how is it that we can drive the value of the dollar higher? Well, we would need to resolve, if you will, that excess supply of dollars. So we would need to make dollars relatively scarce and make yen relatively abundant. So again, the more abundant anything is, whether it's dog food or cars or yen, other things equal, the lower will be its price, and the relatively more scarce something is, the higher will be its price. So to drive the value of the dollar higher and the yen lower will mean that from Japan's point of view, it needs to prevent the dollar from depreciating. So, in other words, prevent its movement from 108 to 105 and prevent the yen from appreciating. So, how do you prevent a decline in the price? Again, you need to make this good relatively scarce. So I have this table here, and so what we have here is kind of how you would think about managing fixed exchange rates. So managing exchange rates, and it has its analogies to how you maintain a fixed exchange rate system. So from the perspective of Japan, right? So up here we have Japan wants to force a depreciation of the yen. So force a depreciation of your country's currency. So in this particular case, the analogy would be your would be Japan. And if it is forcing a depreciation of the yen relative to the dollar, then this is the same thing as forcing an appreciation of the US dollar relative to the yen. So forcing an appreciation of another country's currency, this is the US dollar. So from the perspective of Japan, if it wants to force a depreciation of the yen relative to the dollar, it is the same thing as saying forcing an appreciation of the dollar relative to the yen. And what do? You do the same thing. I mean, they're just flip sides of the same coin. If you want to force a depreciation of your currency, you need to make it relatively more abundant. So you sell your currency, that is to increase its relative abundance in the foreign exchange market. And what would Japan have to do? It would have to buy the foreign currency. So it's going to buy dollars and make dollars relatively scarce. Make US dollars relatively scarce in the foreign exchange market or in international transactions. So to the extent that Japan can issue enough yen and buy up and retire from circulation enough dollars, then it can achieve what it wants to do. Similarly, just to take the other side of this, suppose it's the case that you're in a country and you want to force an appreciation of your country's currency. And that is going to be the same thing as forcing a depreciation of another country's currency. So if, say, the US wants a strong dollar relative to the euro, for instance, then the US wants to force an appreciation is to increase the value of the dollar and force a depreciation of the euro. And what does this mean? Again, I should have probably been more precise. So we want to increase the dollar means we are going to increase the number of euros per dollar. And if we're going to force a depreciation of the euro, we want to conversely, so again, an appreciation of the euro relative to the dollar is a depreciation of the euros relative to the dollar. So increase the number of euros per dollar, which is the same thing as decreasing the number of dollars per euro. So if the United States wanted to intervene in the foreign exchange market and drive the value of the dollar higher, it would do so by doing these two actions. I'm sorry. It would buy its own currency. So the US buys dollars and sells euros. And similarly, it would do the same thing here to prevent or to force a depreciation of the euro. How do you do that? You need to make euro relatively more abundant. So you need to shrink the relative availability of dollars, make them relatively more scarce, and sell euros. So this then just puts these two things together. I think it's kind of a head bender, and I know I probably have said more words than I need. But I think if you kind of think about it and practice with it, it'll make sense. So again, if you are trying to drive the price of something higher, you need to make it scarcer. And if you are trying to drive the price of something lower, you need to make it more abundant. And the price in this case is just an exchange rate. So with that, we reached the end of the discussion of exchange rates, and we will turn in short order to a characterization of the macroeconomy in the short run.